How's everybody doing? Good, good, good. All right, this panel is the Year 15, the annual Awesome Year 15 panel featuring the lovely Cynthia Bast. Always a crowd favorite, and the title is We're Gonna Need a Bigger Boat, and there's no hidden meaning in that at all. There's no Jaws in the water, as Nicole said, please don't make Bank of America Jaws. And I said, no, honestly, I came up with this title during Shark Week. I was making my kids suffer through a Jaws marathon because I'm convinced that movies in the 70s and 80s when I was a kid are better than the movies today. So I'm always making them watch like all the Raiders of the Lost Ark and Carol Burnett and Back to the Future. No, not Stripes. And so we were in the middle of a Jaws marathon, and Christy with TAP was like, Chris, I've got to have the title to your panel for our program or whatever. And around then was my favorite line in the Jaws movie when Captain or Sheriff Brody sees the Jaws shark for the first time, and he turns around and he says, we're going to need a bigger boat. So I just said, we're going to need a bigger boat. That's the name of our panel, and that's what it is, and it has no meaning other than that. So
yeah, no correlation to the topic at hand.
None whatsoever.
He's just big into the maritime industry and business.
All right, my name is Chris Thomas. I am the managing partner of the Austin office of Tidwell Group, which is God's favorite CPA firm, handling all your accounting and tax and consulting needs. I've got an amazing, wonderful panel up here with me, and I'm very happy to once again be with the lovely Cynthia Bast to my immediate left. Cynthia and I think have done a Year 15 panel probably every year since I opened up the Austin office for Resnick 9 years ago. And every year it evolves a little bit. We were joking earlier that 9 years ago our biggest Year 15 concerns were deferred developer fees and exit taxes, paying exit taxes on LP buyouts. And wouldn't we love to be able to say that's our biggest concern today? Cynthia is, oh man, we're missing your bio. So Cynthia will not get introduced any more than this is Cynthia, because she didn't provide her bio. Cynthia is a attorney. Everybody knows Cynthia. She is an attorney with Locke Lord and here in Austin. And when I have a client that is coming to Texas, I often say I wouldn't go to Texas without seeing if Cynthia will represent you. And she's amazing. I love teaming with her on client issues. So that's Cynthia. Next to Cynthia is Nicole Baldwin. Nicole is a senior vice president for proprietary and direct investments for the low-income housing tax credit group at Bank of America Merrill Lynch. Let's see. You graduated from Louisville.
Go Cards.
Nice.
That's Louisville.
I'm sorry, what the,
They say Louisville.
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 And currently resides in Charlotte, North Carolina. Next to Nicole is, everybody knows Barry, come on. Barry's a developer, long time Texas developer with an amazing amount of experience that is here to be shared with all of y'all. Barry graduated from a school in Bloomington, Indiana, which is where my 18-year-old is going to school in about 20 days. I didn't know that, Barry.
I didn't know that either.
Wow. Did you, by chance...
You didn't know that you went to Indiana, or you didn't know that his children were grown there?
There's children.
Yeah, you probably hope, please don't let him have children, right? Did you also get a degree in vocal performance and sing opera like my daughter?
Afraid not.
No.
You don't want me singing up here, believe me. room will vacate very quickly, Chris.
Indiana University's two best features, I think, are their Jacobs School of Music and the Kelly School of Business, which is obviously where Barry went. And at the far end of the table is Lloyd Griffin, who is the co-head of affordable housing for Berkadia. And Lloyd was very specific that he wanted me to read his entire bio, word for word.
I said you could stop there.
Okay, sorry, I misunderstood. So that's it. So what I thought would be neat is to just take a moment, run through the panelists, and just, I mentioned earlier, Cynthia and I were chatting about just how much has changed since we did this last year. And Lloyd actually was on the panel with us last year. So I thought it might be interesting just to run down the panel before I start spewing questions off to them and let them just comment briefly on some of the most pivotal and maybe impactful things or nothing that they've seen in the last year with regard to the year 15 issue. Why don't we start at the far end? Lloyd, you want to?
Thank you, Chris. Yeah, first of all, honored to be on the panel. Certainly, Chris, appreciate your active participation over the years. And I told Christy Sutterfield that, look, I'll serve on a panel, but I want to be on Cynthia's panel because it's great because I can sit here and just like tee up a couple of issues, and then Cynthia can absolutely drill down to the very fine details and does it in a very articulate way. And I think you'll if you don't, for those of you who don't know Cynthia, please get to know her. She is very highly respected in the state and abroad. Did I get cut off? No. And within the industry. Thank you. But I'm basically the chief morale officer on the panel, so I'll throw out jokes. But my job is to wind up Cynthia. But also, very fortunate to have the cerebral. We have Barry here to join us, and Barry has been in the industry longer than I have. Yet he's kind of like Bob Dylan. He still really looks very young, but he can even calculate IRRs using a slide rule. But
Keep dreaming.
Barry drills into details like very few others that I've met in the industry, and always appreciate his perspective. So we're very fortunate to have, along with Nicole, who's joined our panel, we're very fortunate to have very technical, again, I'm just the chief morale officer here, but kind of go into what we've seen over the last 12 months since our last panel last year. Much is the same. It's a great time to be a GP on new business, but it's also a pretty good time to be a GP in connection with year 15 business. That is to say, it's a good time to be a GP if you've done all the things that we had no idea would occur over the ensuing 15 years, and find ourselves in a situation here where we're asking very esoteric questions that very few of us know a lot of detail about. 704B calculations, positive or negative capital counts. It's like, wait, I had a 90-10 residual split. I get 90, right? Why don't you stick to the deal? Well, it's more complicated than that. And so we'll drill down into more details about that. But one thing we have seen is that the capital markets have been incredibly robust. Rates continue to stay really low. Lenders, particularly HUD and the GSEs, Fannie, Freddie, and large money center banks, crave affordability in products that loans that can be applied to low-income housing tax credit deals that are even not only in their first 15 years, but also in their remaining 15 or possibly 30 or longer, depending upon which part of the country you're in and how long your extended use period is. The activity from investors that are not affordable by nature remains very interested in buying deals that have 15, 10 years remaining on the extended use period. They're buying them just like they do market rate assets, and looking at not only trailing 12, but in some instances looking a little bit forward. We are seeing, I guess, we can get into some other options on what we've seen GPs do when they reach this 15-year period, on whether or not they hold or whether or not they sell outright, or buy their GP, their LP interest, and then re-syndicate the property. I think last year, just a preview, last year we didn't have full visibility on rule changes that allowed for an existing GP to possibly participate in a re-syndication of their property. And we can get into kind of how that's evolved, and we haven't seen a lot of deals come through just yet, but that availability exists now. I guess again, I would just say that debt is widely available. We can get into as many details as you want, and I'll turn it back over to Chris.
Barry, briefly, let me hear what your sort of thoughts are on where things are in the market on year 15 and what you've seen the past year.
Well, first of all, I'd like to say Cynthia got started when she was about 14.
Why is everybody picking on you?
Otherwise, we don't want to tell. I mean, she looks like she started when she was 14. Anyhow, we haven't really been in the overall market. We've just been dealing with our own portfolio, and we've seen anything on our exits with something very simple where the investor wanted to just get out. There had been negative cash flows, which we had covered over the years, and they didn't want to deal with picking up those types of issues. On the other end, we had one transaction which was heavily contested. So what you're going to see is a whole variety of situations, depending on where you are, the quality of the deal, and above all, what your relationship is with the investor. If you've got a close relationship, you've done a bunch of deals with them, they're profiting from you in a variety of other ways, you're going to have a much better exit strategy than if you've tried to jump around and get the best deal every time you get a new deal. And at the end of the day, you're dealing with multiple investors. Well, if there's no relationship, they're going to stick to the rules. And they're going to try to get the maximum out of you, where, as I say, otherwise, if you've got a great relationship with them, if you've got new deals coming up and you promise those, you may have a much more favorable result.
Nicole, how are things in Charlotte? What's going on?
Good afternoon. Thank you, Chris. So I probably will start with just giving you an overview of our portfolio. We have approximately $12.4 billion in combined equity commitments, and that includes our direct and indirect portfolios. We have approximately 340,000 units, which is 4,400 properties across the country. The majority of those are in our multi-investor portfolio. Out of the 4,400 properties, approximately 580 are on our watch list, which is about 8% of our total equity. We would do approximately, can you hear me?
It did the same thing to me. I think
Okay.
they're trying to send us a message.
We would do approximately $1.4 billion across the equity platform, which includes LIHTC, historic, new markets, and solar. We are investing about 80% direct and 20% through our syndicator partners. The majority of our business is on a direct basis, and we have built a strong platform on that strategy. That being said, our syndicator relationships continue to play a very important role. Better efficiency on a smaller scale. There are just some markets that we do not efficiently cover. The direct investment platform started in 2007, so we have not begun to dispose of anything in that portfolio just yet. However, we have disposed of our legacy investments from other banks that we acquired over the years, and that number is about 3,000 to date. The majority of those deals were transferred to the general partner for a nominal amount because the deals were so over-leveraged. Typically, we will not exit until year 15. However, if we are approached, we will look at whether if it makes sense from an earnings perspective. And each deal is done on a case-by-case basis. We are relationship-driven, and we will follow the parameters in the partnership agreement. An internal evaluation is prepared using the appropriate market cap rate, and we will discuss exit options with our general partners. Back to you, Chris.
Well, thank you for that. And how about Cynthia? What are you seeing? Anything new since we sat up here last year? I guess we were at the Hilton last year.
I would say that I am working on some sort of what I call second life transaction every single day in my practice. At any given time, I probably have a dozen or more properties on my desk that are working on some sort of restructuring or refinance anywhere between, say, years 10 and 16, 17, and 18. So what I'm seeing a lot of are GP sales of GP interests. There's a very active market for the GP interests themselves as opposed to the properties. One thing that we see in that arena is challenges with approvals, because any change of GP requires an approval from the investor if the investor is still in the deal, or from the lender. And those challenges can have a variety of issues. If there's an economic issue with the property, then the investor may want to negotiate something special. And it goes back to what Lloyd said, which is to have that relationship with all of your parties, which sometimes is hard to maintain. I understand that. We have syndicators that have changed over the years. We have debt that's been sold. We have servicers that have changed. And so sometimes it's hard to keep up with those relationships, but I can tell you that when you do have them, it can make it a lot easier when you're in that Second Life era trying to do a GP sale. Another thing I'm seeing a lot of are GPs buying out the LPs, either at the GP's request or the LP's request. Sometimes there is an option in the partnership agreement that's very specific and defines a price, and sometimes there is not. I would say that a lot of times I am seeing the GPs be surprised at the price that the investor is asking for. The investors are, remember that they have a duty to, if they're a syndicator, to their ultimate investor, or if they're a direct investor to their ultimate shareholders, to try to maximize that investment. And they see value in these deals. And the prices that they're asking for are really not always what the general partners expected. All of these GP and partnership interest transactions are all geared toward trying to avoid the right of first refusal. Most 9% deals in Texas have a right of first refusal in your LURA, where if you're going to dispose of the property itself, you have to offer that property up at what we call the 42I7B price, which is the price specified in the code at essentially debt plus exit taxes. Selling a GP interest, selling an LP interest individually does not trigger that ROFR, and so there can be value maximized by doing that rather than selling at that more bargain price. I will say that I think that the legislation from last session in 2015 has helped. HB 3576, if you weren't familiar with it, did make some revisions to our ROFR legislation and some of our back-end issues, and I think it has helped. The other thing that I would say is, so if you can't avoid the ROFR, or you want to actually do a real estate disposition, then how do you work within the ROFR? And one of the things that we have now is the ability to sell effectively directly to a qualified organization, which can include a nonprofit, can also include a tenant organization, can also include a governmental entity, all of which can now operate through a limited partnership or limited liability company that they can control, which is very critical, was a big deal in the last legislation. So what I'm seeing is a lot of owners going out and finding those nonprofits to negotiate with on a flat-out disposition if they want to do a real estate disposition. And there are some very sophisticated nonprofits out there who are very active and aggressive and seeking these properties. There are brokers who have client bases of nonprofits who are actively seeking these properties. And so I think there are sellers who are finding ways to dispose of their properties within the ROFR restrictions that they find desirable. A couple things that happen in the real estate disposition realm is, one, I find a lot of investors want the owner to go out to the market rather than just doing an off-market sale. A lot of times the owner will want to do an off-market sale to avoid broker fees. Sorry, Cliff, I think I saw you in the room. Or things like that. But the investors really, again, to honor their duties to the people that they're ultimately responsible for, they want to know that they're really getting the best possible price. So a lot of times they want to go see an actual marketing through a brokerage firm. The other thing that we see, and Chris and I can talk about this for days, is what happens with the disposition of those proceeds. We're seeing a lot of old partnership agreements where liquidation proceeds, which liquidation occurs when you sell your property, have to be distributed in accordance with capital accounts, as opposed to that 90-10 or 80-20 or even 50-50 split that you thought you negotiated for sale or refinancing proceeds. And owners are finding out, owners being GPs are finding out that maybe those splits don't really apply on a sale of a property because the liquidation distributions override that. And so that has been a really big issue and a big surprise, I think, for many general partners as to how that is working for them. I would say the last thing is, and Lloyd mentioned this, resyndication. HB 3576 did allow for properties with ROFRs to still go through a resyndication, which was not previously permitted. I have not seen a lot of that yet. I think we've got some that are working their way through the process to position themselves for that, but I have not seen a lot of that yet. But I think that will probably be next year's panel.
Yeah, I can remember a couple of things following up on what you said. I think 2 years ago this panel was called It's Year 15, The End of the Rainbow, Where's My Pot of Gold? Or where did all my money go, or something like that? Where did all my residual go? And that capital account, the 704B tax, in the provision there in 704B of the tax code that comes in and overrides the business deal is something that, again, 9 years ago we didn't envision, and we spent this time talking about deferred developer fees and how we get those paid and how we deal with exit taxes. But today, that's a big part of why we have this panel every year is to what can we do on an existing deal to try to stay true to the business deal that you struck that allowed a general partner to have a 50% split of the residual or 80% or 90%, and why that's not in the cards anymore. And the other being, I'm trying to do a deal today. What do I need in my partnership agreement to make sure that I do a better job of protecting my residual according to the business deal that we struck, that we just struck, a month ago. So that is, and when we all got together as panelists, I got the program out and said, okay, this is what we've committed to the audience, which is you, that we were going to talk about. And that said, what's most important to me is that we're addressing what everyone wants to hear about. So we've got a microphone there. We're small enough where you don't need to come and stand at the microphone unless, Barry Kahn last year, I think, wanted to use the microphone in the middle of the room, but I just put him up here instead so he doesn't have to stand there for so long. But anybody else, just raise your hand if there's something that we touch on at any point. We've always, we're not the best at doing PowerPoints, and so we've always been very conversational in our approach up here. So if there's something you want us to elaborate on or go deeper in, please raise your hand and let us know. And
all right.
Hi.
Let's start.
You want us to do more Lloyd's Bio?
I have a question to Cynthia in terms of people buying GPs. How do they insulate taking on the old liabilities of the GP?
That's a very good question. Typically, instead of buying the GP itself, so let's say the GP is a limited liability company. So instead of buying ownership of that limited liability company, most of the time what they're doing is they're buying the partnership interest, bringing their own entity into that partnership and acquiring that partnership interest. And so as part of that negotiation, what you agree to is typically an indemnification where the prior general partner indemnifies the new general partner for anything that occurs that might impact that new general partner that really related to the prior general partner's position. Now, of course, that indemnity is only as good as the pockets are deep, right? But that is something that is typically part of the negotiation. And then I would also go to the LP and say, okay, LP, you can't hold this new GP accountable for anything that this prior GP did as well. But there are a lot of considerations there. There are considerations about, for instance, TDHCA compliance history. What are you stepping into? Are you going to step yourself right into a Category 4 previous participation? That could be an issue. So those are all things that you need to think about in your due diligence if you're the buying partner in that scenario.
And I would elaborate on that. I think a couple of friends in the room have experienced this with me, which is they're looking at a GP interest and they think they've got a certain value because they're looking purely at cash flow, right? And they're not they're probably not going and looking through the partnership agreement on what it says for a year 15 exit, and they may think that there's a certain residual there, and they may not go and take another step and look at that LP partner capital account and realize that what they thought they were going to get 80 or 90% or that, the pot of gold at the end of the rainbow, there is no value there whatsoever. So they could find themselves, without getting their trustee CPA involved, to find themselves overpaying for something where thinking that there's a set amount of residual at the back end, but there's not. Another thing that you could think about is what the language itself is with regards to exit. A lot of times it's silent. If it's an older deal, there could be a forced sale provision in there, depending on the state. It could be, you don't even have a chance to try to negotiate with the LP on that positive capital account because they're like, we're going to just wait for the dissolution and the sale, and we're going to get all our money. But I have seen people buy a GP interest and try to renegotiate with the LP at that point. She's leaving right now to try to go renegotiate her deal. And I have seen people have some success to approach the LP and say, hey, we want to buy this GP interest. We need your approval anyways, but while we're at it, let's talk about how we're going to get you the heck out of here in 3 years or something along those lines. Lloyd, you do a lot on you've seen probably quite a bit on the sales of GP interest. Anything else you want to add on in terms of what people might want to think about?
I think three things that have been touched on that are most prevalent in every GP sale, and frankly, anytime a transfer of ownership interest in any meaningful amount occurs, and that is early get out in front with your LP, and because you're not on the sales cycle, you're now kind of in more the servicer realm and asset management realm, and so leverage your relationships with those entities through the sales side to help navigate you through the waters in the back office to help ensure you get those done in a timely manner, because two parties in a real estate transaction enter into a PSA and things typically begin to move real rapidly. And certainly you want them to move rapidly. States to get their consent and buy off, lenders to get resubordinations of your LURA regulatory agreement, lenders to approve assumption and the connection of assumption. Most of the time these involve a full refinance. And so all of this is going to involve multiple points of contact with your investor, your existing lender, and the state. And if you have a sub-debt, any sub-debt like home funds that are not administered by the state, but perhaps by Travis County or Harris County, Bexar County, they need to be looped into for the resubordination of their subordinate loan documents with the new lender, even if it's the same lender and you're refinancing. So I can't stress the relationship aspect of it enough, because you many times will get dropped off into the abyss in the back office realm, and many times those folks are there to handle certain tasks that are very standardized, and they may not really know how to help you, and which is why it's important to kind of try your best to approach through the sales side and ask them for. Without promising your firstborn to please help me navigate through this, even though we closed 12 years ago or 9 years ago. But GP sales, we're seeing less one-offs and a lot more Pac-Man moves, and it takes an incredible amount of time and energy for, because a lot of these buyers are very sophisticated, but they may not have a huge amount of experience in the LIHTC business. So as everyone who's done one of these, most everyone knows, there are very few LPAs that are alike. I mean, they continuously evolve. So they're looking at a real estate and they're looking at an economics trade, and then they start diving into each one-off. So there's no scalability in terms of evaluating it. You can certainly evaluate the real estate side and the income and the expense side, but then when the residuals and then evaluating the capital accounts, things can get real messy in a hurry. So that's when, before one might contemplate in terms of maybe looking at succession planning and saying, I've given a lot to this industry and it's time to sell my 3,000 units, and someone's standing there offering a nice price, that's when you really need to coordinate with your legal team, like Cynthia, and certainly Chris, to help walk you through some of the unknowns, because they have not only the experience of what's occurred within one's own portfolio, but thousands upon thousands of others, and then even like Barry, who's been able to be involved throughout the cycle and dissect it from top to bottom, and now is still actually, believe it or not, doing new deals, in spite of having gone through a full cycle. So there are a lot of us left around here that are still alive that survived the first 15 years starting in 86 and early 90s. But there's a lot of info to glean from those folks, and GP sales are very complicated. And again, it's not just a portfolio trade. You're looking at every single LPA. So just bear that in mind, that you need to get out in front of those parties mentioned early and often.
How'd that answer your question?
Flynn, question.
Yes, ma'am, Flynn.
My question is around best practices and due diligence in making a selection of a general partner and avoiding some of those obstacles you mentioned, Cynthia, like the approval process. So as an active general partner or a developer looking to make an insertion or a replacement of a general partner, what are the best practices in doing your due diligence to select that incoming GP?
So are you talking about the buyer side or the seller side, or both? And Nicole, I think it'd be interesting for you to jump in here too. I think on the seller side, one thing you want to know is that the purchaser is going to has a good, if you're in Texas, has a good compliance record with TDHCA, because the last thing you want to do is go through the pain of negotiating a purchase contract and then find out that you have a potential buyer that has a previous participation problem. Secondly, I think you want to look at, does this purchaser have requisite experience, a requisite balance sheet? Are they underwritable? And Nicole, I think that's where you would come in terms of what would, for instance, an investor look at for a purchaser of a GP interest?
So we would look at the GP's financial condition, the sources and uses, the cost-benefit analysis, and then the distribution of proceeds. So that's what we will look at.
Then flipping it around, if you are the buyer, I think that you're going to want to look at, first of all, the compliance record of the property you're getting into. So I go back to that same issue. It really applies on both sides. I think you're going to want to look at who is the investor. I think we're starting to learn in this industry right now, which investors are more flexible, are more open to selling perhaps before the end of the compliance period, after the end of the compliance period, which ones are not really open to changes. There's some that just say, we don't do a deal before the end of the compliance period. They just kind of take that position. So you want to look at that, and before you spend a lot of time, try to figure out, is this someone that we think will even accept a new general partner? And same way with the lender and the loan. That loan is very likely to have some sort of significant transfer restrictions, probably a fee that has to be payable in conjunction with a transfer review by the lender. So you want to know what that's all about. And that is then, of course, on top of all your standard real estate due diligence for doing an acquisition of a GP interest.
And there's one other thing that somebody, on both sides needs to be aware of is what are the guarantees if you're buying a GP interest or selling one as to how they're going to be handled post-sale. Is the buyer willing to take on the 15-year compliance guarantees that are in place? And is the seller getting off the hook, or are they going to have to remain on them? So that's probably one of the more challenging issues that's addressed on a general partner sale.
And I think it's always fun when you have an enjoyable panel, a very knowledgeable panel like this, and we've probably spent 5-6 hours together in preparation for this. And one of the things that came up was, even if you have the approvals from the GPLP on year 15 buyout, whether on an LP buyout or a transfer, is we realize the stumbling block of the servicer themselves. And Cynthia, you and Barry both talked about the struggles that y'all have seen on that.
You may have a great relationship with the lender or with an originator at their lender, but if you have but the servicer may be a totally different party. And I've experienced that with servicers where you go in for an approval and you kind of get to the back of the line, and eventually you get to the top of someone's desk, and then they give you this list of things that you have to provide, and then you turn all that in, and then you hear from them a month later and they need something else. And it can be, if you don't have a relationship at all with that servicer and you're just dealing with the person who processes these kinds of things, it can take a while.
Well, not only that, but they generally pull out a book that says ABC. Well, if your deal isn't in their ABC, getting them to change may be like moving a mountain.
Barry, I want to stay with, sorry. John, hey.
9 years, a short answer on deferred developer fees.
I'm sorry, I missed the very beginning of it.
Rewind 9 years.
Uh-huh.
What did you say 9 years ago?
On deferred developer fees.
Oh, yeah. Back before we realized the significance of Internal Revenue Code 704B on the year 15 LP buyout process, we would talk about year 15 and we would talk about deferred developer fees. I mean, what are we going to do with deferred developer fees? How are you going to deal with that issue? And it still remains an issue that comes up often. I don't like to do it, at LP exit, because I think we're all in agreement. We're not seeing, and Nicole was very clear that B of A wants to see that before the LP exit event, the deferred developer fee get cleaned up. I hate to say get paid, because we all know
It may not be possible.
yeah.
In other words, see Chris before you get to year 15.
Yeah.
So and deferred developer fee is easier to deal with at like year 6.
And that is what we used to talk about 9 years ago, about things like starting to take it into income in tranches, year by year, in regular installments. We also talked about the concept of refinancing deferred developer fee, and basically like selling the DDF to another party and it being deemed paid. Making
it a must-pay item. There's all kinds of things that you can do. earlier better than later. You can sort of forgive it. That leads into a discussion of if you're forgiving a deferred developer fee liability. Is there an impact on eligible basis? No. So those are the things that we used to sit up here and think and talk
But if you
about.
create income.
Right. How do you deal with the phantom income of paying yourself? But we do have an amazing, intelligent IU grad down there that I have a question for. And Barry, relationships are a key component on an LP buyout, and as Lloyd mentioned, and also you have been around a while, and you're seeing your first deals start cycle through, and are you thinking of is there a re-syndication? Is there a re-syndication in your future? I know you had the failed attempt at the American Warriors, the Gladiator show, and but how did your LP buyout go? And any lessons learned, and what's the plan? What are you going to do with your first tax credit deals that you did, 15 plus years ago?
Well, first of all, on the LP buyouts, one thing I'll say is don't let the investor talk you into a brokered letter. A broker is going to try to come up with a value as high as possible because he wants that listing. Be very careful if that's proposed to you, and never agree to be bound by it, because
It's not an appraisal.
It's
right?
not an appraisal, and if you need something of value, what you really want to do is focus more on the appraisal approach. And one of the real challenges is, how is the appraiser instructed to make the appraisal? These properties that are 15 years old in our industry are pretty beat up. And when we were building in the 90s, we had much lower budgets from TDHCA. So the higher quality wasn't there in top of the tougher tenant mix. Usually these properties at the end of year 15 that were built in the 90s are generally in need of a lot of deferred maintenance, or half deferred maintenance, which needs to be repaired for the long term. Whether you're going to sell the property, whether you're going to re-syndicate it, whether you're going to refinance it, the lender's going to do their physical needs standard. So when you do an appraisal to take out the limited partner, one thing you're always going to want to look at is, really, what can this be sold for? I mean, what's a buyer going to look at? One, they're going to look at the condition. So that needs to be factored into the appraisal. Secondly, the first year of the credits starts before you're in your permanent loan. So if you're in the old historical Fannie 15-year deals with yield maintenance and at much higher interest rates than what the market is today, if you want to sell it or refinance it or resyndicate it and have to get new debt, there's going to be a fairly, year and a half of yield maintenance, which can be a sizable number. So again, from the thought of an appraisal, what's a willing buyer willing to pay? But you need to look at those types of factors and try to get them built in the appraisal when you're trying to come up with a value. And that can be a huge challenge, because naturally the investor, they're saying, well, that's not our problem. So, it's all part of the negotiation you're going to have and with the third-party appraiser. Again, good relationships with your investor are probably the most relevant matter. If you've developed a bad relationship because you fought over things over the year, you haven't really complied with your end of the bargain at different times, you're going to have a much more difficult challenge when you try to buy them out and what you can get to be agreed upon in the appraisal. Then what are we going to do with properties? Right now we're trying to deal with the year 15s as they come up. Some of us are getting older in the industry and probably looking to do some sort of package resale. And so as one gets into that, not only do you have to post year 15 deals, which are much easier to value, but the general partnership interests, which are pre-year 15, And those have a whole host of other issues that you have to be careful with.
Yeah, thanks, Barry. I appreciate that. And so you're looking at potentially holding these things for a set amount of time and then selling them off. So Lloyd, given that, if you were talking to Barry, what kind of things could he expect in a sale? Anything that you would suggest to him? Recommendations?
So I would say to work very closely to what I call kind of categorize and delineate the partnerships into different classifications. Okay, so if I have, let's say, Barry, how many LPs did you work with? And he'd say, well, just one. I'm like, well, thank goodness, this is great. So let's go through the highlights and articulate very clearly to a potential buyer or communicating through a broker so that there's no misinformation. Because oftentimes when a book goes on the street for a year 15 deal, it gets 200 people signing up for information, and then maybe 25 folks end up going to look at it. Then it could get down to like 5, but you really want to whittle it down to save your timing and maximize the sales price by communicating here's what's going on with our LPAs. And it will absolutely smooth out their due diligence process and help speed up the sale. We have had a lot of large, very sophisticated buyers enter into contracts for pretty sizable portfolios that they simply spent way too much money on legal, and they figured this portfolio had probably 16 different investors, and every single one was different residuals, different splits, different waterfalls. Everything was different. Lingering guarantees. And of course, they were closed in different vintages, and so they had different provisions. They also were in different states, so they had varying regulatory agreements and things of that sort. So I think what we were able to do is to try to add value, is to take your portfolio and chunk it up and offer it to those who are interested in those particular deal types, right? Who can master and understand. You take the easy ones, you throw those right out to the street. You take the more complex ones and you go to someone who's not looking to execute on their first GP acquisition, right? You look for somebody who's on their 4th, 5th, or 6th, or 7th, and can make quick work out of it, because these things, I've seen them go on for over 2 years and fail and miss an entire cycle potentially. I mean, not necessarily the last 5 because it continues to ride, but there have been some that failed to execute because a lack of understanding and good information flow to the potential buyer. And everyone can figure out debt terms, yield maintenance, asset, expenses, income, rent restrictions. That's not a problem. It's really in the accounting side of the deal where even very large, sophisticated investors with big names on big streets get completely derailed. And they go into it thinking it's a real estate trade and forget that there's something else going on.
And there are plenty of non-tax credit investors out there looking for these properties and looking for GP interests.
And some are doing very well with it and have a voracious appetite. I think they've been tired of showing up as bridesmaids on market rate acquisitions and coming in 2nd, 3rd, 4th, 5th, and have found a lot of value in deals that have, even though they have lingering rent restrictions, they're in good markets and they're good locations. And some of these properties have been well maintained, and with where rates are today and equity expectations, conventional equity expectations, they're meeting their investors' expectations and putting more than a ham sandwich in their pocket, buying good quality, affordable deals that have 10, 15 years and remaining rent restrictions.
Until I get that call that says, what do you mean I have to do this stuff with TDHCA?
Right.
Who are these people? Why are they on my property?
Yeah.
and that happens. You have these people who are not accustomed to our business, and then I get the call that says, what's this agency and what is this all about? I thought I just had to charge these lower rents. I had no idea that there was going to be this other piece to it. So that's always an interesting conversation. I say, well, good luck.
Yes, sir.
If at year 15 or beyond, if you have a buyer that's willing to pay the market value for a property and that market value is greater than a minimum price, can they do it, and if so, how?
If you have a right of first refusal and you're after year 15, and if you want to sell for more than the 42 I-7B price, then the strategy is to sell to a buyer that is controlled by a nonprofit organization, tenant organization, or governmental entity, which could include a housing authority or housing finance corporation. And there, you think that that does limit your pool of potential buyers, and it does, but there are good potential buyers out there that are maybe national nonprofits, or there are also some Texas nonprofits that I know well, and there are some housing authorities and housing finance corporations that are also interested in these kinds of transactions as well to add to their portfolio. So there are buyers out there. There just may not be as many if you have a ROFR on your property.
And by the way, Cynthia's approach is very wise, because actually we talked about this last year. We had a relationship on both sides with multiple parties in a deal in Georgia, and one buyer came along and they were going to execute on a re-syndication, right, and recapitalize the deal. The above ROFR purchase price was thrown out and it was gobbled up and taken away, and another party took the deal and ran with it, and they said, well, I guess we've learned our lesson, and lost control of the deal. But they still made money, right? But they just didn't, they weren't able to fulfill their business execution, right? But what you just asked has actually happened, unless you kind of put belts and suspenders on it and run through a qualified entity.
I want to spend some time talking a little bit now. We've covered a lot of different options, and one, obviously, the main sort of probably first thing that a GP wants to do as he approaches year 15 is they want to buy out the limited partner. And I spend every day talking to clients about the pain and suffering that they're going through currently on a deal like Barry has that was done 10, 15 years ago with a certain type of partnership agreement language. And then the second question inevitably is, okay, I'm putting this deal together now. What language can I put in there that gives me better protection of keeping the residual true to the business agreement that we reached? Cynthia, when you see older deals, and when Barry called and spoke about the LP buyout and the pain and the suffering, what is that driven by? Why is there that pain?
Sure. And I was thinking we should kind of give the basics on the 704B issue. But we all spend a lot of time in our letters of intent with our equity investors negotiating the waterfall provisions, right? And we have two waterfalls. We have our cash flow waterfall, and then we have our sale or refinancing proceeds waterfall. And the common thought is that sale or refinancing proceeds waterfall, whatever that says is the final item on the list, that's your split of whatever sale proceeds you may have. Well, under 704B of the tax code, in order for partnership allocations to be properly respected, a liquidating event, the proceeds from a liquidating event, and when you have a single asset partnership, sale of that property is a liquidating event, have to go in accordance with positive capital accounts. in that ratio, which overrides the ratio at the end of your sale or refinancing proceeds waterfall. So what happens in a lot of the old partnership agreements that we have is you've got your sale or refinancing proceeds waterfall in about, section 7, and then back here in section 12, there's the winding up and dissolution provisions that everybody has fallen asleep by the time they get to page 80 in section 12, and so no one's ever really looked at it. And what it says is, notwithstanding anything in this agreement to the contrary, liquidating proceeds go in accordance with capital accounts. And if that's all it says, you may have a problem. Because on a typical 9% deal, especially now with prices being so high, your investors' capital accounts are going to still be pretty healthy at the end of the day. And one of the things that we don't see our clients doing a lot is an upfront capital account analysis. We don't see our clients asking their investors for a copy of their projections and their capital account analysis. We don't see our clients going to their accountants and saying, would you do a capital account analysis on this? They just want to close the deal. They don't even want to think about it. And so I get this call every so often where I say, the client says, I'm going to sell this property and we're going to have $2 million of proceeds, and I thought we had a 50-50 split and I was supposed to get $1 million, and the investor's saying that I don't get anything because their capital account is too big. And how did that happen? And I explained to them how the liquidating proceeds work, and that's a really unhappy surprise for them. So one of the things that ways that partnership agreements have evolved and that partnership agreements are trying to do now.
Well, before you get to that,
Okay.
is you're at that point with the old deal.
Okay, so let's be in the old deal.
Yeah,
All
yeah.
right,
You're
so
in the
let's not
old
jump ahead.
deal, and I say, is there any way out of this? What can we do? I don't want to lose the $2 million of my residual just because my LP partner capital account is $2 million. What can I do at year 14?
Well, and there are, that's when you go talk to Chris and Garrick, his partner, because there may be allocation adjustments that could be made. There could be, for instance, a cost segregation study that would allow additional depreciation to be allocated to the investor that might bring that capital account down some. There are accounting procedures like that. You might suggest some others where you can perhaps make some adjustments to the capital accounts that will balance things out a little bit better. Will it be perfect? No, but it could be better.
And whatever you do, at that point, you are at the LP's mercy.
Absolutely.
There's nothing you can do accounting-wise or on the tax return at that point unilaterally without the approval of the LP. So my point in all of this is it's something that is needing to be debated, dealt with. It's not going to go away. If you've got a great relationship like Barry spoke about earlier, that's important. Nicole, I think as you were talking about different things at the bank, it became very obvious that y'all are very relationship driven.
Yes, we are. We're relationship driven, and at that point, we will negotiate, and I think it's just so important to have that relationship. And even now, if you're considering a deal, we feel that the disposition process starts when you sign the partnership agreement. So really talk about those things up front. But yes, we are relationship driven, and we will talk and negotiate, and it'll be fair. What I've seen is that we have made fair decisions. If there's value, we're not going to just leave it on the table, but we're going to negotiate with our general partner.
Hey, Chris, may I ask a question? So the cost segregation analysis you're referring to on, let's say you're reevaluating things or in per your advice in year 7, 8, 9, 10. Of course, those deals were closed on certain metrics like pricing. Equity pricing back then was, let's say, 85 cents, and rates were 6.5%, 7%, and amortization was maybe 30 years. So today, if someone, if this week someone is fortunate enough to be the top ranked in Region 6 and they have an equity LOI at $1.10 and it's a 9% deal in a 130 area and their debt's at 5% for 35 or 40 years amortization, I mean, huge equity amount, right? So how does that play out? Just for somebody like me, pull out the crayons and say, okay, in today's market metrics, you may have a problem. You should order that capital account analysis, which will help one get at least grenade close on projecting into the future. So how does the rate and the terms of today's market impact a capital account?
Yeah, I think there's a two-prong approach. One is you get Cynthia's team involved and you try to find some language that you can include in the partnership agreement, and I'll let Cynthia elaborate, that maybe is a little, and I don't want to say this as GP friendly, but it's language that brings keeps the project more in line with that a business agreement that was inked on the LOI, where residual was going to go 90-10 or 80-20 or 50-50. And there's some things that I'll let Cynthia elaborate on from that point. And then on the accounting side, if we know that capital accounts at year 15 are going to drive the residual, doesn't it seem obvious that let's figure out a way to drive the capital account ourselves as the general partner or as we are inking the deal, right? And so how do you do that? Well, you do that by doing a capital account analysis. And I think, Nicole, you mentioned that while you as a bank, and I'm sure it's probably across the board, most investors or syndicators are running numbers, you're not necessarily running a capital account analysis.
Well, we're proactively managing our capital account.
For sure, but it used to be, well,
yeah, we actually go to you or our accountant.
Right. So,
which means you're being very conservative in your
Exactly.
depreciation. You're not necessarily taking all the depreciation you could potentially take, which keeps that capital account up. That's what did you say? Proactively
managing.
Managing our capital accounts. That's what that means.
and that was a big deal, 15, 20 years ago when pricing was in the 70s or even below. The biggest hurdle that you had on a tax delivery or the guarantee of delivery for a GP was trying to make sure that too much capital account wasn't burned off and that the LP was going to be able to take their allocation in year 9, 10, 11 to get their credits. Today, it's very different, and their motivation, an LP's motivation on capital account analysis is very different from what a GP wants. So what can you do? Obviously, we've got a capital account analysis, and it says, boom, we're going to be at $2 million of positive capital account at year 15. Well, that's unacceptable, right? Because we do now know that if there's $2 million of residual, guess where it's going? It's going to feed that positive capital account. And so what can we do? Chris Thomas at Tidwell Group, we got $2 million of positive capital account. Well, let's look at that. What can we do? How can we generate some more losses in this deal? The first and most obvious is through depreciation. We don't need to be as conservative. And you might think, well, that's Nicole's job to determine how much depreciation they want. Well, yes and no, right? After the deal is inked, I agree. You're not going to be able to do many things without having the approval of your LP. If you're inking the deal now and you're going out and you're taking your deal to limited partner investors and you say, this is my deal, I'm doing a cost segregation study, I've got Tidwell Group and they're going to run through this analysis, you're going to love it because you're going to get more of the depreciation. I'm giving you 80 bips and on your yield. You're going to love it. And you love it because under this new revised depreciation stream, that capital account's now $100,000 in year 15 because you jammed more depreciation down in years 1 through 15 instead of it all being backloaded and under, getting straight line depreciation over 27.5 years. So I think, Lloyd, that's what you were talking about. Cynthia, what about the language what can we do language-wise that might allow for us to potentially avoid a liquidating event with a positive capital account?
There's a couple things that I think that we can do, and things that I'm seeing in LPAs right now. One is that in that liquidation section back in section 12, about page 80, we say that it is the intent of the parties that liquidation proceeds will be distributed the same as sale or refinancing proceeds, and that we're going to do everything we can do with our allocations to make sure that capital accounts get to the point where we can do that. Notwithstanding, of course, if they don't, you're still going to distribute in accordance with positive capital accounts. But it's at least an affirmative statement that we're going to work with our accountants to try to maximize the opportunity to get to the intended split that was in your sale or refinancing proceeds section. Another thing that you can potentially do in your sale or refinancing proceeds section is build in some more fee income to the general partner, which is another way to get economics to the general partner before you get to that final split that has to go in accordance with capital accounts. So for instance, you could put in a disposition fee for the general partner. You know, I try to always make sure that to the extent there is any deferred developer fee, that's in there. You know, maybe other fees that don't get paid could accrue, and maybe those could go in there. Anything that you could kind of layer up in that waterfall so that some of that cash is going to the general partner first before you get to that final split could also potentially be helpful in a disposition scenario. One other thing I would mention, stepping out of disposition of the real estate into buying out the limited partner. This is a topic that we were discussing quite a bit immediately before this session. What is the price for buying out the limited partner? First of all, I always recommend that our clients have an option to buy out the LP in the partnership agreement. Again, that option has to be at fair market value because, again, for allocations to be respected, it has to be a fair market value option. So what is fair market value, and how do you define fair market value? Can be hugely important. Does it go to that broker's opinion, a broker letter? Does it go to an appraisal? And what are we appraising? Are we appraising the LP interest itself? Are we appraising the property? And then looking at some disposition scenario? One of the things we've done with Barry, if you don't mind me using you as an example, is for a long time is the purchase price we use is you do a hypothetical sale of the property at the fair market value, considering continued affordability restrictions. You take those proceeds, you distribute them through the sale or refinancing proceeds waterfall without regard to the overriding liquidation distribution. So basically that 90-10 split or 50-50 split or whatever it is, and whatever the investor would get under that scenario, that's how we define fair market value. Now, in today's market, where investors know their capital accounts are going to be quite high, I don't know if they would go for that price. And then, Nicole, I think that goes back to relationships. You know, maybe on your first deal you're not going to get that price, but maybe if your fifth deal into it, you might get that price. But you need to think about very carefully, if you want to preserve your property and continue to own your property as opposed to selling your property, then getting that investor out is really critical, and knowing what that price is going to be is very important, and trying to get that price somewhere where it makes sense for you.
That was a lot of information, both from the accounting and capital account standpoint that I talked about and what Cynthia talked about from the partnership agreement language. Yep. Any questions on that? I want to make sure that everybody has a good understanding of, if nothing else, that you probably need to hire Cynthia and I for every deal coming forward. One thing
I'd love
that
to have been, listening in on the call between you and Barry. I think the phone wires probably melted from just the It's
Well,
amazing.
I do think it's interesting, and Barry, you mentioned it on one of the calls that you thought it was important to make sure when you're doing your fair value assessment that there is also an engineering assessment of the current state of the project and capital needs assessment.
No, absolutely. All that needs to be part of the appraisal process when you are buying someone out. And just to actually clarify the record, Cynthia was actually representing the syndicator in our first deals.
And he negotiated against us for 8 hours. I think he gave us
No,
2 bathroom breaks.
No, I had Mark Grossberg, who was a top-tier tax attorney, and he led me through all the stuff and said, this is what you have to ask for. But anyhow, it's been fun.
And I hope this panel has been fun. According to my watch, it is. We've got about 2 minutes left. So, if we don't have any other questions, we are available up here if somebody wants to come by. Otherwise, I want to thank my panelists, and I want to thank everybody in the audience for coming and hearing about this exciting stuff.
Thank you.